Hey guys, welcome back to the channel. So, a lot of people are asking me like the difference between income tax and capital gains tax, and all, some of the ins and outs of it. So, I kind of want to get into that today, talk about the difference, and what each one entails, right? I'm going to try and keep this as short as I can, and not too long, right? So, first off, income tax, right? It's paid on earnings from employment, interest, dividends, royalties, or self employment, whether it's in the form of services, money, or property. Okay? Capital gains tax is paid on income that derives from the sale or exchange of an asset, such as a stock or property that's categorized as a capital asset, right? So let's first kind of dive into income tax, and then we'll get into capital gains tax a little bit after, and try to work out some of the details, right? So your income tax percentage is variable based on your specific tax bracket, right? And this is dependent on how much income you make throughout the entire calendar year. So the tax brackets also vary depending on whether you file as an individual or jointly with a spouse. Um, in 2020, federal income tax percentages ranged from 10% to 37% of a person's taxable yearly income, right? After deductions, of course, right? So, in the United States, we have a progressive tax system, right? A lot of other countries do as well. Lower income individuals are taxed at lower rates than higher income taxpayers on the presumption that those with higher incomes have a greater ability to pay more. However, the progressive system is marginal. Segments of income are taxed at different rates. The rates for a single filer in 2021, right, for example, um, so 10% on income up to 9,950, 12% on income over 9,950. It's 22% on income over 40,500, 24% on income over 86,375, 32% on income over 165,000, 35% on income over 209,000, and then of course 37% being the top bracket on income over 523,600, right? Again, still 10% at the lowest and 37% at the highest. And of course, anything under 9,950 is, you know, it doesn't get, there's no income tax on it, right? So this is going to lead us into the capital gains tax, right? So capital gains tax rates, right, depend on how long the seller owned or held the asset. So short-term capital gains, right, or for assets that are held less than a year, right? And these are going to be taxed at ordinary income rates, right? Like we just talked about. However, if you held an asset for more than a year, then more preferential long term capital gains applies. And these rates are 0%, 15%, or 20%, right? And of course, again, that's going to depend on, the amount of money you make, right? Your income. So, last year, in 2020, a single filer pays 0% on long term capital gains if that person's income is 40,000 or less. The rate is 15% if the person's income falls below 441,450, and then 20% if it's over that 441,000, right? Now, in 2021, the thresholds are a little higher, right? It's 0% on 40,400 or, under, and then 15% on 445,850 or less, and then of course 20% if it's over that amount, right? So not much higher, and of course these keep raising basically every year, right? They'll go up a little bit more every year. An individual, must pay taxes at the short-term capital gains rate, which is at the same as ordinary income tax rate if an asset is held for 1 year less. So, like we were saying earlier, if you make you know, if you're the top, if you make over $523,600 a year, you're paying 37% on your income. So short term capital gains rate is going to apply. It's going to be 37%, right? So you're going to pay 37%, right? So that's why we're saying it's based on your income. It'll go back to those normal brackets, right? So how would you calculate a capital gain? Okay. Well, the amount of a capital gain is arrived at by determining your cost basis, right, in that asset. So we've been talking about real estate recently, so let's just do real estate. So let's say you purchase a property for $10,000, right? And let's say you spend $1,000 on improving it, right? Then your basis is $11,000. So if you then sold that for $20,000, your gain is 9,000, right? Because you sold it for 20,000 and you put 11,000 into it. So 20,000 minus 11,000, 9,000, right? Well, let's do an example of income tax versus capital gains tax, right? So let's say I earned $35,000 in 2020, right? So the way this is going to work is I'm going to pay 10% on the first $9,875 of income. And then I'm going to pay 12% on the income that comes after that, right? So my total tax liability would be a little over $4,000, right? And then, if let's say, so that's income tax. Let's do a capital gains example. So let's say I had an asset, right? Let's say I sell that, right? I sell an asset and it produced a short term capital gain of 1,000, right? Then my tax liability is going to go up by another $120, right? Because I'm paying it's 12%, right? That's my highest tax bracket. So that's where I'm currently getting taxed at, right? So 12% of 1,000 is $120, right? However, if Joe waits 1 year and 1 day to sell, then he would pay 0% on the capital gain, right? So it's all about waiting over that year, right? So I really hope this kind of lets you guys know the difference between the two, and you can kind of understand that short-term capital gains, you can really like those taxes can really eat away at your profits, right? So if you're gonna look to invest or sell or flip properties or whatever you're gonna do, make sure you're aware of your capital gains tax and income tax brackets and all that good stuff, right? I hope you guys enjoyed this video. If you did, go ahead and hit the like button. If you're not already subscribed to the channel, I'd really appreciate it if you did. That's how I see you guys in the next video. Y'all be safe.